Hello everyone. Today, we're exploring the three ways companies account for greenhouse gas emissions: equity basis, financial control basis, and operational control basis, as outlined by the GHG protocol. These approaches help organizations report emissions, especially Scope 3, which covers indirect emissions from their value chain, like supply chains or investments. Let's break them down with clear examples. First, the equity basis. This allocates emissions based on your ownership percentage in a company or project, no control required. Imagine an investment firm with a 30% stake in a solar panel factory. The factory emits 100,000 tons of CO2 equivalent annually, including Scope 1, direct emissions, Scope 2, electricity, and Scope 3, supply chain. Under the equity basis, the firm reports 30% of those emissions, or 30,000 tons, matching its ownership share. This approach is ideal for investors or companies with minority stakes in joint ventures, reflecting their financial responsibility without needing control. Next, the financial control basis. Here, you report 100% of emissions from entities where you can direct financial and operating policies for economic benefit, even if you don't own 100%. Picture a conglomerate owning 60% of a beverage bottling plant and controlling its budget and strategy. The plant emits 50,000 tons of CO2 equivalent, including Scope 3 emissions from its supply chain, like plastic bottle production. Because the conglomerate has financial control, it reports all 50,000 tons, not just 60%. This aligns with financial accounting standards, like IFRS or GAAP, where you consolidate controlled entities. It's perfect for subsidiaries or investments where you make the financial calls, ensuring emissions reflect your economic influence. Now, the operational control basis. This focuses on operations you directly manage, reporting 100% of their emissions, regardless of ownership. Imagine a retailer leasing a warehouse and controlling its daily operations, lighting, logistics, waste handling. The warehouse generates 20,000 tons of CO2 equivalent, including Scope 3 emissions from transporting goods. Since the retailer has operational control, it reports all 20,000 tons, even with zero ownership. This approach suits companies that can influence emissions through operational decisions, like optimizing energy or supply chains. It's about what you manage, not what you own. So, what's the difference? Equity basis ties emissions to your ownership share, no control needed. Financial control covers 100% of emissions from entities you financially govern. Operational control covers 100% of emissions from operations you manage. For Scope 3, these apply to investments, supply chains, or leased assets. For example, a bank might use financial control to report emissions from financed projects, or equity for minority stakes. Choose one approach consistently to avoid double counting, and disclose it clearly in your ESG reports. Any questions? Let's discuss.